Well, the entire NBFC space is rattled right now for a variety of reasons, including liquidity scare, which suddenly gripped the market recently, and the entire sector got derated momentarily. So we thought of getting you an analysis with one of the largest NBFCs in the country. I have with me for a special chat Mr. Dinanath Dubhashi of L&T Financials to discuss the sector and how they are trying to take steps to differentiate themselves. Mr. Dubhashi, thank you very much for your time today.
Thank you.
And I really look forward to the interaction.
Me too.
So let's talk about the scare which temporarily gripped the market recently, be it liquidity, and it all started with ILFS issue, in fact, a couple of months back, and now it seemed to be spreading. There was one transaction done by one mutual fund in a private company's paper, but is there really reason to the entire sector to be gripped by the kind of panic it did recently?
I have a very particular view about this, that scares, panics are almost never justified fully, right? That is not to say that there is nothing wrong or everything is right in any sector. Let's take the last 2 years. Demonetization was a scare. Many other things, GST was a scare. And now this liquidity issue is a scare. Market reacts in a particular way, where market has to. Company managements have to make sure that, first of all, they have to take cycles in their stride. No business model should be built without taking cycles into consideration. Companies are built for perpetuity, and every 5 years, interest rate, liquidity, various cycles will come and go. And company models, if they are robust enough to handle those cycles, those companies will survive. Now this, I know it sounds like God's own truth, but funnily speaking or ironically, this is what strong companies are made of, right? So I will answer your question in a minute, but let me take this opportunity to just talk about where we are placed today, right? Because of various measures we have taken, we are very liquid. The 1 year liquidity is positive, and in fact what is called as the interest rate sensitivity is today placed in a way that with interest rates going up we benefit, and we are also liquid.
Sure.
This is just the commercial, talking about our company, but let us take a few steps back and talk about what makes a company which can live through this cycle. Number one, and these are very fundamental things. Number one is your business model or your product strengths so robust that when the market is going up, you gain more than everybody else, and when times are bad, you lose less than everybody else. Build that first. Second, very important, is keep your eyes firmly on risk. A chief executive who doesn't keep his eyes on two things, one is capital allocation and second is risk, is not a chief executive, is a cowboy, right? And these two things matter tremendously for fighting cycles. And last but not the least, something that we as L&T Group and L&T Finance hold very close to us is transparency. That these are the times that people look for a face that they can trust.
Sure.
And you have to establish a track record of transparency even when times are good.
Sure.
Share with the market, share with analysts, share with investors how you manage the company. The more you communicate, the more clearly, consistently you communicate. What you say in bad times is believed when you are saying that consistently in good times as well, right?
Sure.
So scares will be there. Companies will do good and bad, industries will do good and bad, but strength of business model, focus on risk and transparency is the three-pronged mantra which will build any good company, and we of course belong to the L&T group and
Sure.
we live by these principles.
No, I'll definitely come on the details, the way you are operating the company. You recently put out your investor presentation as well. I'll come to the elements, but I want you as a formidable player in the industry to analyze the environment for the NBFC space right now, because the market seems to be derating the entire sector right now on the risks which have come at the horizon. I want you to analyze that for us.
Sure, I'll do that. let's actually take a few steps back and look at the last 2 years, right? The last 2 years, if you take industry by industry, sector by sector, financing sector by sector, NBFCs and private banks have actually taken share from public sector banks. NBFCs with their strengths of easy reach, far-reaching reach, easy processes, innovative thinking have really made financing more accessible and perhaps more stronger by going more digital, data analytics, etc. The market had rewarded this, and definitely last 2 years it was a story to talk about, NBFCs in general, right? When something negative happens, then at that point of time, perhaps this euphoria which has happened takes a back seat and think, okay, have we missed some risks altogether? The market then starts treating everybody equally, right? When market is rising, sometimes even bad players go up, and when market is falling, maybe the price stocks of good players also come down. I take all this as noise.
Okay.
Forget ups and downs in the market. I actually believe that even though a chief executive should work for shareholder wealth, that shareholder wealth should be in ROE and PAT and not looking at share price on a day-to-day basis. Sure. Generally speaking, yes, of course, we have to see that the shareholder wealth increases, but not on a day-to-day basis. This panic, let's remove it for the time being from the stock market.
Sure.
Because how any panic or how any euphoria quickly reflects is in the stock market, which actually is not right. From, as an investor, yes, but as a company management, you should take a few steps back and say, okay, where are the real risks, right? The real risks for the sector emerge from, let's say, 2 or 3 important places. It's very simple things, right? How have you lent? Credit is, I think most people do credit well. Most people. Unless and until somebody takes unnecessary risk, you do credit well. Nobody lends thinking ki NPA hoga, right? So most people do credit well. What people forget is risk, right? That are we taking too much exposure to a sector? Are we taking too much exposure to a particular group? Are we taking too much exposure to a particular geography? What is important is to put very strict risk control, risk limits, risk appetite statement in place. So this is number one on the asset side. On the liability side, if a NBFC is not seeing far enough or long enough, in a short-sightedness, sometimes what can happen is in the hunger to keep your borrowing costs low, you may just go too short. You may fund long-term balance sheet by long-term assets by short-term, and which will expose you to both interest rate risk and even more importantly liquidity risk. No NBFC or bank or any financing company can survive if the liquidity risk goes bad. And hence, even more than the asset side risk, managing of the liability side risk, making sure that even at a negative carry, even at an insurance premium, so to say, you don't overdo your hunger of having cheap funds and keep yourself liquid. It should get disproportionate attention. So both these risks are real. These are simple financial risks. I have not yet come to the non-financial risk. These are financial risk, asset side risk, liability side risk. I normally talk very basic things. And the liability side risk doesn't get, according to me, enough attention across the sector. There are some companies, I think we give absolutely disproportionate attention to liability side risk. And just to give you an example, and I talked about it, we are very liquid. Our ALCO actually have representation from L&T Treasury. And this kind of, we get a overall view. Our chief economist, who is a very well-known lady, Dr. Nitsure, she sits on ALCO. We take her opinions very seriously. We have a 3-tiered structure to manage interest rate risk. I just put up a presentation in the public space talking about it. The kind of, the point I'm trying to make is it's a risk which is just now coming into focus because of problems. But do you remember liability side risk being even talked about till 6 months back, right? Till 6 months back when interest rates go. And this is the problem, because we focus as a NBFC sector or even banks, we focus too much on asset quality, credit, which is very important.
But
the liability side doesn't even get any attention, any space on television, analysts, nowhere.
No, fair point.
And that's very, very important.
In fact, I would like to take your opinion on this point only, taking it further. You just put up a analyst presentation on the website as well as on Bombay Stock Exchange website, which is actually getting a lot of attention due to one particular plate where you actually mentioned how half of your loan book is actually at a fixed rate and the large portion is floating, and you benefit from interest rates going up because rates are heading higher, yields are heading higher, and that has become a big issue for the entire sector.
Yes, and it's not a coincidence. We are in a happy position today. It's not a coincidence, but it comes from a very deep-rooted philosophy of mine. And many times, sometimes I sound like God's own truth, because I believe in certain philosophies. And this philosophy is that you have to provide for the rainy day when the going is good. When the going is bad, you should use those stories, right? The insurance premium that you have paid for all those time will come to your benefit, right? Most of the times, companies start doing certain things for risk when the going is bad. That's not the time. When the going is good, you are making a lot of money, and at that point of time, you should take some insurance premiums. On the asset side, you provide more when the going is good. Otherwise, you end up providing where NPAs are going up. Actually, you should provide when the going is good. We started doing that after we adopted Ind AS, and we increased our provision coverages when NPAs are coming down, right? On the liability side, when the interest rates were coming down, the temptation to go short, to further reduce interest rates, because on the asset side your yields are coming down, right? The temptation of drastically reducing interest rates by going short is very high, but we kept away from that. In the same principle that you use for provisioning on the asset side, we went long. When the interest rates were coming down, our economists saw that the cycle is about to turn, and close to 53% of our liabilities we booked for 4 years now residual maturity, and at about 8.2, 8.3%, which was very high at that time. Because that time, short term money was available at maybe 7 or even lower. And that time we booked at 8%. And I told my asset side that yes, I am increasing my liability cost to buy an insurance premium, and you have to make that money. And today, yes, in the proverbial way, we are laughing all the way to the bank. But it's not luck, it's the cost, it's the insurance premium that we have taken when interest rates were coming down. And there is one chart which shows that our interest cost has actually gone up by 3 basis points in the last 3 or 4 months, when market costs have gone up by almost 100 basis points, right? And that has happened because of this. So as you rightly said, just 47% of my liabilities will come up for repricing, and vis-a-vis 65% of my assets which will come up for repricing.
So much higher contribution actually from the assets.
Of assets which will come up for repricing. And when the climate is like this, when interest rates are going up, it is also reasonably easy to pass on the increase. And then one more thing which is very important is as you get better and better positions in the industries that you are, in your lending industries, so infrastructure or rural, the better your competitive position, you are that much better placed to pass on the increase as well. And there are the 3 principles by which we are managed. One is what I talked about, taking an insurance premium when going is good. Second is being strong in the market so you can pass on interest rate hikes. Third, most important, and maybe I am passing on some trade secrets, is remembering that NIMS is can go up and down, and hence your only insurance against this is fees. And hence for the last 2.5 years, we have made this major push on cross-selling, on making fees.
So the contribution
that
of fee base increases.
Keep increasing, and it sort of assures you of a steady NIMS plus fees metric, and that's it's important to have high profitability. It is important to have a good ROE. It is important to have a top quartile ROE, but it is way more important to have low volatility of this ROE.
Yes.
Way more important.
Yes.
You can't have 25 one year and 5 next year, or a loss next year. I'd much rather have that 18, 19 every year.
So stability or return ratio
is way more important. And if you see each of the things that I talked about shows the focus that we have on stability. We are too small, too new a story to advise to the world, but this is something that we believe.
But talking of infrastructure, did you have any exposure to some of these troubled groups which are now coming in the focus, ILFS or for that matter?
So look, lending to any company, right? If you lend unsecured, if you lend, and this is again, these are deep rooted thing, right? Let's say a group which is going down, you have a direct exposure on the balance sheet, you will have a problem, right? The exposure that we would have to any such group will be on operating road projects, which are annuity projects, where who is the owner doesn't matter. I mean, the project will get sold and we will get our repayment back, because it's an established road, getting annuities from government, operating roads. So I can only assure that we don't see any issues whatsoever coming from this. We are not worried. Why name only one group, right? Again, when you lend, you are taking a basic credit risk, right? Today it is one group, tomorrow it can be somebody else, right? How you structure your lending? Are you completely depending on the promoter? Are you completely depending on the balance sheet? We don't have any lending like that.
Okay.
We have moved completely. The corporate lending is not only asset backed, cash flow backed, and those cash flows will be, established over a period of years, over a period of a few years, and that's, I would say, good philosophy of lending. Otherwise, you are guessing, right? I mean, the group that you mentioned was a very good risk till 1 year back or 2 years back, definitely, and many people would have lent to it. The problem is, if you do lending just based on a name, then when the name goes down, you can't blame the name. You have to blame yourself, right? And all our lending is project based. In fact, we have gone in public space saying that if you remove in infrastructure, if you remove our gross stage 3, which is about 5,500 crores, which is all our legacy portfolio and well provided for, of the rest of the portfolio, close to 90% is operating projects. And the rest is under construction, but that to be completed over a short term, right? And that, I believe, while promoter will always remain important, you should reduce the name risk, the promoter risk as much as possible, and move it to project risk, because project risk is something that you can assess and it can remain good throughout.
All right, time for a very short break. After this break, we will talk about how Mr. Dubhashi is focusing on return ratios, how are they managing them, improving them. In fact, record improvement in the last 2 years, the ROE almost doubled to 18%. We will get into the details of L&T Finance after this very short break. Still in conversation with Mr. Dinanath Dubhashi of L&T Financials. Mr. Dubhashi, the other thing I wanted to speak to you specifically about your focus on ROE. Industry talks about it as well, and your repeated presentations, I've seen the first slide has got a magnifying glass on the first slide with ROE on it. What brings the company and the management such sharp focus on ROE, and why is it so important?
See, I believe, and this I learned in perhaps my first lecture in management college, that a body corporate exists for the shareholders. It's basics, right? I believe in basics. I believe in no jargon, absolute basics. And if you exist for the shareholders, then there is one metric which benefits the shareholders, which is ROE. So this is the conceptual part. But if you go a little bit in our history, we listed in 2011. We belong to a great house, to a great group. But between 2011 to 2016, we didn't perform like our pedigree may demand, right? And finally, there were many reasons. Maybe we wanted to become a bank, our cost became too high. But the main reason was that we took our eyes off the ROE.
Okay.
Our ROE, which at the time of listing, at the time of the issue was close to 16-17%, fell to 9% by March 16. When we analyzed, there were many reasons, but clearly we concluded that this is a metric that we need to focus on. Along with ROE, we also focus on growth, because just ROE or just cost cuts doesn't work. But if there is a single metric that shows the strength of the company, it's ROE. And we put that metric straight away there in the public space, saying that from bottom quartile, we will move to top quartile by 2020. And we actually set targets that we will do every year. Not only that, we linked management remuneration, me and my number twos, straight to that if every year's ROE and PAT target is not met, we will carry home zero bonus, and which is a large part of our cash components. And that really brought the entire focus of the company to ROE. What we have also done is, you and I understand ROEs. What about that? We have about 15,000 people. What about that last person on the ground? What's ROE for him, right? So what we have done is, in his KRAs, in his KPIs, we have converted what ROE means for him. Like a tractor finance sales guy, how many tractors he sells, how many, a particular brand tractor he sells, what is his productivity, what are the early defaults or zero bucket collections. Those are his ROE linked criteria. So everything links to ROE in the company.
In fact, in the last 2 years, we have seen your own company's ROE almost double from 9% to 18%, astonishing. And perhaps that also, if you map ROE improvement to the stock price, there's a high correlation. But now everybody's got a taste of the kind of stuff you guys are doing at L&T Finance. So what would you like to say? Would you like to keep it stable at current levels, or do you see scope? Where are the levers which you can press, for which there can be scope for improvement?
Interesting question, and we need to take a step back and say what caused this increase, right? It was not that the climate was only good. We also had lots of problems over the last 2 years. But three things which caused this increase is, one, our steady focus on doing only a few products that we are good in, and continuously improve our market position in those products. That is number one. Number two, keeping our eyes on expenses, first expense cut and then expense control by productivity. This number two. And number three, continuously improving our asset quality. Continuously, quarter by quarter, improving asset quality, and hence reducing credit costs. These are the three things which have worked for ROE, right? And fundamentals, very simple again. And that, because of that, it also answers the question that you asked, that what now in the future? Naturally, we would like to maintain this ROE at 18, this kind of top quartile. We would like to grow it, most definitely, but the higher focus is on keeping the volatility at the minimum, right? You can show an average of 18 by showing 30% 1 year and 10% next year. We would like to keep this 18-19 in a very, very tight range. And the way we do that is very interesting, that the top line is NIMs plus fees. We try to maintain our NIMs plus fees by continuously improving our market position. Next is cost. We maintain a very close control on cost. There are very interesting anecdotes on that. And then finally credit cost. And then what remains is the ROA of around between 2.5 odd %, which gets the ROE to around 18%, right? Now the whole idea here, the concept is that in NIMs plus fees will vary based on market conditions, right? because the other two you keep in tight control. When your NIMs plus fees are higher than average, you actually provide more. You provide for the rainy day, and if they are lower than average, you use those provisions, and that causes the PAT, the ROA to be steady. We have just reached this 18%
Yes.
ROE, and clearly the future focus will be on, the extra push will be on the word steady.
Right.
Steady ROE, steady growth, and very low variability in results.
So the other thing I wanted to talk to you about sector and how you have made a very reasonable, market share or footprint, I would say, on the rural side. Not many on the street actually know that after M&M Finance, you are the largest tractor financer, agri equipment, you have a big and or increasing focus on the rural side. One, I want to understand from you, what is the state of rural India right now? How big is the size of the opportunity for NBFCs such as yours and your peers who are doing well in the rural side at a time when a large part of the Indian banking system, which is PSUs, which catered to the rural India, is kind of shut for business?
Okay, there are several questions that you have asked. Let me answer the first one very simply. What is the state of rural India? Right? I think the state of rural India will always go through cycles again based on monsoons, but overall, structurally, it is improving.
Okay.
Structurally, the kind of infrastructure, the kind of support which is being provided to rural India is reducing the time from, from the field to money, field to bank, as we say. And the farmer's ability to encash his crop is better and better. So, for example, this year, the monsoon is not great. It is just about a little bit below the average, actually, below average. But the way rural India's cash flows have been managed, generally speaking, there is, a sort of euphoria in rural India. If you see tractor growth, if you see two-wheeler growth, it is all being almost at a high rural India. And where is this coming from? Because it has gone the other way than monsoon, right? Monsoon is not great. It is okay, not great, but the status of rural India is very good.
Okay.
Now coming to lending, this is very important. So first of all, why did we push? Very simply, when we started, we had a good position in rural India, but more importantly, our balance sheet was 66% wholesale. And no good diversified company can accept that. And we started saying, okay, first wholesale will reduce to below 50 and then more. We are now wholesale at just about 50, little above 50. And we will grow both in rural as well as housing. Rural, we played a different game. Rural lending, it was always okay, when monsoon is good, you lend more, monsoon is bad. It was very branch based lending. We were also like that till 2 years back. And we took a contrarian call that data is available in rural India and we will use data and digital. Today our rural processes are completely paper free. They are entirely dependent on data. What this does is our access to rural India is better, faster, and credit costs and productivity can be much, much, much better. When this happens and when this happens in the industry, and we are not that worried about competition because the industry will expand as more and more people lend better in rural India. Interest rates will come down, lending costs will come down, and the market will expand. And at this point of time, the opportunity in rural India is so high that every company should look at expanding the market while making money for itself rather than worrying too much about competition.
Okay.
Because more people who come, lend well, it is good for the sector.
Sure.
And that's our firm belief actually in rural India.
Okay, so last question. Up till now, your growth has been, the story at L&T Finance has been IPO and then nothing happening for some time, and then realization, rejigging the processes and sharp ROE improvement to what you got it now, and the ball is rolling nicely. From here on, what's the strategy in terms of growth? Would you like to have growth the way you're doing it, or are you also looking at some inorganic opportunities, because there is a lot of M&A in this space? Would you like to acquire growth as well?
Why not? I mean, of course, all possibilities are open. We always keep our doors open for any opportunities. This is answering it simply. But let's go once again to the fundamentals, right? What have we done well? We have managed our risk well, starting from bottom, which Great, we will continue doing that. We have managed our expenses well, we will continue doing that. We have managed our top line NIMs well, we will continue doing that. And last but not the least, till now we have managed our growth well. Now when the growth has to continue over the next 5-10 years, there will be a part of growth which will be possible by the existing products, by improving your competitive position in existing products, and there is a part of growth where you will launch a few new products. We will never get back to those 25 products where we had, but a few new products where we can take leadership positions is what we will get into, largely along the adjacencies of what we do. Right? When we do that, obviously both internal, organic, as well as inorganic will be options to follow.
Okay.
And
but nothing
like any good management, we will be open. Oh, of course, nothing on the table.
Okay, great. It was great chatting with you, Mr. Dubhashi, and look forward to more interesting insights and great relationship with our channel.
Thank you
very much for your time.
Thank you.
Great.